essentially, my next 10, 12 minutes is about framing the discussion and giving you a sort of a feel of how we think at LaSalle about risks and which ones have we decided to really focus on. But before that, I guess one of the key things we should remind ourselves is performance. We're dealing with an asset class that has actually outperformed. If this may be a bit small, but just focus on the colors and the cells. Left-hand side, you have stocks, global bonds, global government bonds. These are total returns. And then on the right-hand side, you have, for a select number of countries, Australia, Canada, US direct, UK direct property, unleveraged total returns. And in the middle, you have global securities, real estate securities, and global real estate. So what you could see is that our asset class has really done the job. I think we should celebrate that. But the key question, of course, is if you look at the shorter end of what's happened lately, that sort of over the first few months of this year, things have started to change a little bit, and global corporate bonds and global real estate securities have actually outperformed. But just bear this in mind. Real estate has done a tremendous job in delivering returns over 1, 3, 5, 10, 20 years. So the question, of course, is where are we in this cycle? So what we do is we start off by positioning capital markets. This is investment volumes. The horizontal line is average 10-year investment volumes in different countries. So, how active the investment market has been. And as you can see, there's a group of countries who have, really went above their long-term averages. That's Japan, the United Kingdom, the United States. We know that they're probably in advance of the cycle. Then there's a group essentially of Eurozone countries, plus Australia, and then Italy is lagging and not yet into with the trading volumes that we had in the previous cycle. And the question is, if you take a view about capital markets, how long are we going to stay in that mature cycle? What may happen after that? What kind of risks could actually topple us into that declining part of the cycle? And the question is really about real estate fundamentals. This is demand-supply equilibrium, and we look at where we are in this cycle. And again, Japan, UK, the United States, fundamentals are catching up, but we're probably more spread out if you look at the other countries, such as Germany, Spain, Australia, and the other countries. And Italy is just beginning post-trough recovery. If you pause here and look at the relative pricing, this is a key element that many institutional investors look at today in allocating between different property types and between different asset classes. So what you have here, just first of all, focus on the little dots here, the orange dots. These are yield spreads, spot, April, when we look at these, of prime property yields versus 10-year government bond yields. As a rule of thumb, many institutional investors would look at this as, that's my buffer, that's my remuneration for going into illiquid direct property today. And the bars, the corresponding bars for each of these countries, correspond to the 10-year average of that spread. And as you could see, first of all, most of the dots, with maybe just that one exception in Singapore, are above today, spot, above their 10-year long-term average. So the remuneration for investing in direct real estate is actually pretty rich. The question, of course, is, what could actually topple that? So which way are we going? I think we should probably look at short-term risks. Just roll back a couple of months. We started the year with a lot of angst. Remember credit conditions, top, market, equity markets tumbling. This is a good measure of financial conditions. This is the Goldman Sachs Financial Conditions Index, and we actually went up pretty strongly. We're probably in a better position now. But literally, we were in a position where we're asking, is this the end of that sort of cycle in the capital markets? But actually, if you look at what's happening today, the conditions in China, conditions in the US, they're actually improving. We're probably not yet at a point where things are toppling. Could the risk actually come from oil markets? This is the direction of travel of oil prices since April 2014. And these are the different forwards as we observe them. That's on the 29th of April. And going forward, up until the back end of this decade, Oil prices are not expected, and the trades which are happening on these forward curves are just pointing to $50, $55 per barrel. So again, probably not a shock coming up from over there. The one thing maybe to mention in terms of short-term risks is that hedging today has become more costly. A lot of investors are telling us that global diversification, or just diversification within a region, is more costly. That's one of the elements they have to take into account, and these are sort of just changes in local currency values just year on year. And as you can see, some of them can be pretty extreme. Not necessarily focusing on the left-hand side, but just look at 5–10% volatility is causing that cost of diversification at an international level to increase significantly. So in a world of low bond yields and low returns, that cost is becoming meaningful. And then if we just sum up this short term, what we do at LaSalle is we look at different imbalances, both for each country, supply, demand, debt equity, pricing. I don't have time to go into any degree of detail, but as you can see, we're not seeing immediate 6 to 12, 18 months sort of major risks of a major downturn. But of course, the one that stands out here is the UK, and this is essentially linked to the outflows in property unit trusts in the past 2–3 months, and the fact that CDS spreads on banks have actually spiked up pretty significantly. Probably something we'll discuss in a moment in terms of the panel. Of course, I can't talk about short-term risks without mentioning this risk. My colleagues in the US, about 6 months ago, were putting a very, very low probability. This was a high-impact, low probability event. It's now become a medium to high probability, but still high impact. There's another one, of course, which is closer to us here, which is this one. And again, we can go back and talk about how this plays. We'll know in the next month or so. So medium-term risks, and I think these are probably more relevant for the asset class in general. The one thing that worries us globally is this on this graph. Look at the direction of travel for growth in China. Look at the direction of travel for Chinese debt overall. So at this stage, we've just pushed the risks further ahead, but really this is one of the things we should mention. And then, of course, probably the most important is interest rates and negative yields. This is a complicated graph, but the only thing I want you to focus on is this vertical axis. This represents traded iOS interbank lending, and what you can read here is the implied date. How many years is the market expecting to see a 25 basis point increase in interbank lending? Eurozone, that's 5 years from now. The Fed, that's probably about a year, and the UK, it's wobbling between 3 and 4 years from now. Okay, so there's an engrinded, increasingly strong belief that this lower for longer is going to be even longer. And probably this is probably the most important slide. This is the bond yields, government bond yields across the world. You may have seen this presented to you in different conferences. I think it is very important. It is actually, there's a situation today where about a quarter of government bond yields traded globally are in negative yield territory across maturities. And if you just focus on Europe, that's a third. So you actually have to pay to invest in these papers. And a lot of institutions, your clients, our clients, are actually forced by regulation to invest in this paper. So I think the intentions are good. Why are we having this? Simply to push debt costs lower, to actually improve productive investments, to boost exports and lower depreciate currencies and boost exports, as well as creating a wealth effect on real assets. That's all good, but it's risky. I just want to list a couple of very important consequences if this lasts more, as we could see, more than 2–3 years. Future pensioners are actually having to save more to keep just their standards of living. Banks are weakened, regulatory capital is actually becoming costly for them. Pension funds liabilities rise in value because their discount rate is actually very, very low to not negative yet, but extreme. And then finally, in our analysis, this is pushing real estate prices or real asset prices out of fair value territory. We're in uncharted waters as we speak. And this problem had been pointed out 3-4 years ago here in the UK. It actually is also more recently has had a very well documented impact on allocations from global institutions. We've seen that happen in Switzerland, and we're seeing it happen in the Netherlands. I just picked up this news recently where a pension fund, and funnily enough, it's the accountants' pension fund in the Netherlands, that had to increase by 10% the contributions of existing workers and decrease by 10% the forward-looking pension payments to pensioners. Now that's a massive knock on your income if you're working and your income if you're a pensioner. This is all attributable to low to negative interest rates. Long-term risks, and just before I wrap up, I think the most important theme in long-term risk for us is accelerated obsolescence. If you invest in real estate today, the one question, of course, you're probably looking at the short-term cash flows, underwriting, but how about long-term obsolescence? What's happening with, I'm just giving a couple of examples here, but you could think of many, many other examples, drones, or you could think of how to build buildings. Any and every conference today that actually talks about these long-term risks, but never gives you the right feel about what happens with your real estate portfolio. So sticking to good locations is one way to hedge, but I think we can discuss about what other things we can do with our portfolios. And then finally, Richard, it's accelerated obsolescence has to do with responsible investment and greening buildings. And now you've talked about it. And sorry that Christoph is not here, but I picked up in 2011. I think this one was from Union. That was a funny one, which I wanted to highlight. Finally, just summing up, Richard, I think if I sum up the couple of risks that we really want to focus on, I guess short term, this is all to do with politics. I don't know what the probability would be to end up this year with a pretty stark situation where we have Brexit and we have Trump. You can attribute 30% chance to each of these events happening. That's still roughly 10% overall that we may end up in a situation we have to deal with, which is a bit uncertain, and have to rethink our portfolios. So clearly that's the number one short-term risk. Debt, in our opinion, is the one thing you should focus on in the medium term, and the implication of negative interest rates and negative yields. It creates opportunities. There's one market which actually illustrates that, that's Japan, but also, this is not a long-term play. You have to be out before normalization or some form of brutal unwinding. And then long-term, this is really about obsolescence. How do you reposition your portfolios? What do you do with your portfolios to actually make sure you hedge and maybe eventually, actually benefit from tech disruptors and, carbon-heavy real estate?